Hey there. Are you working at an insurance company responsible for real estate or infrastructure investments? If so, this event was designed specifically for you. Join us for the second annual Insurers Real Assets Forum, March 18th and 19th, 2026, in beautiful Philadelphia. We're focusing exclusively on real estate and infrastructure with a program built for LPs by LPs, centered on real-world challenges insurers face in managing these asset classes. All LP attendees will have the opportunity to participate in 6 private one-on-one meetings with GPs, each offering distinct real estate and infrastructure investment strategies. It's a highly efficient way to compare approaches, ask tough questions, and build meaningful relationships all in one day. We encourage you to bring your junior and senior associates to this event. It offers a tremendous development opportunity for early career investors, whether they're new to real assets or building on initial experience. Visit insuranceaum.com/events to register today for the Insurers Real Asset Forum and explore our other upcoming events. We look forward to seeing you in Philadelphia. Welcome to another edition of the insuranceaum.com podcast.
Commercial real estate investors like to buy everything when it feels really good and sell everything when it feels really bad.
So many people were looking for a recession, and that just hasn't happened.
In the last 18 to 24 months, we've created more data than all of humanity before it.
We're coming into 2026 on pretty solid footing.
My name's Stuart Foley. I'll be your host. Hey, welcome back to the home of the world's smartest money. It is 2026. We're thrilled to be back with you. For those of you who don't know, my name is Stuart Foley, CFA, founder and senior advisor to insuranceaum.com, also the principal architect of the upcoming CIAM designation, which stands for the Chartered Insurance Investment Manager designation. As many of you know, or most of you know, there is no textbook for insurance asset management, and this is an attempt being issued by the institutes, which is our parent. And I think that it is expected in the first quarter of 26 here. And I think when you see it, you'll be impressed with what they've come up with here. So super happy to be back here. Took a little time off over the holidays. And this is a really important topic. And it is an insurance investors podcast today. This isn't asset class specific. This is really about things that you deal with on an ongoing basis that, suffice to say, nobody gets paid necessarily to talk about this topic. And the topic is how tactical asset allocation, or TAA, fits inside long-term strategic asset allocation framework. And for insurers, as you all know, it's not about market timing, it's discipline, governance, capital efficiency, and making thoughtful adjustments in response to changing market conditions. And given the geopolitical environment, there's plenty of what's affectionately known as exogenous shocks to markets, in addition to the economic impacts as well. I'm thrilled to be joined today by Kerry O'Brien, head of multi-asset solutions at MetLife Investment Management, and Harold Myers, CFA, director and insurance strategist within MIMS, which stands for MetLife Investment Management, Insurance Asset Management Group. Together, they bring decades of experience managing complex insurance portfolios across cycles, geographies, and capital regimes. Kerry and Harold, welcome to the program.
Thanks, Stuart. Great to be here.
Thanks for having us.
Yeah, we're thrilled. Here we go. So, icebreaker questions. We've got a slightly new one for 2026. But we're going to start with Kerry. Where'd you grow up? What was your high school mascot? And what job would you like to be doing, if not this one?
So I grew up on Long Island, a town called Bethpage. I went to Bethpage High School, home of the Golden Eagles. And if I was not doing this job right now, I would like to be a ski instructor teaching young people how to ski. And I actually contemplated that when I was outsourced in this investment world, insurance outsourced, and we were going to have some time off. And I thought, you know what, maybe I'll make it to the mountain for this season and teach kids how to ski. But anyway.
That's super cool. I got 2 stories for you. My daughter was in Park City over the holidays and sent me a picture of the mountain, which was dirt, like 0.0 snow, right? The second thing is, when I was like way younger, like 30 years ago, I was in a class where it was all kids and me. And on skis, I'm like 6'5". And right when the instructor started talking, I lost my balance. I was on the low side of the hill because I'm so much taller than everybody else. I mean, I was like 30 and the next one was like 7. And so I fell over and I dominoed all the kids down. I mean, it was so embarrassing. I can't even tell you. So Harold, next up for you, same set of questions. Where'd you grow up? What was your high school mascot? And what job would you like to be doing if not this one?
Yeah, so I grew up in Orange County, New York, in a small town of Montgomery, which is about an hour and a half north of our Whippany office here in New Jersey. And my high school mascot was the Eagles. And the job I would like to have after insurance asset management, and I guess only if I could go back in time, would be the lead guitarist in a famous rock band. I played in a lot of bands when I was younger, and I had delusions of grandeur for quite a long time until I realized that my talents and abilities were probably better served for insurance asset management.
Listen, man, that's awesome. I mean, really, seriously, that's somebody said this. I can't remember who it was, but it was a pretty famous quote who said even movie stars want to be rock stars. So absolutely, I love it. So let's get into it here. And I think it's really about the foundation. And so for insurance investors, how do you define strategic asset allocation? And why does it remain the foundation for a successful investment program? I think that goes to you, Kerry.
Yeah. So it's a very thoughtful question and one that is really embedded in insurance asset management and the insurance business, given that the purpose is to build resilient portfolios that are capital efficient, provide the income to pay claims, and are able to weather all sorts of fluctuations in the market. So when we think about doing a strategic asset allocation, we need to factor in a number of core principles, which includes matching the liabilities. And that means understanding how liabilities behave in all sorts of scenarios, generating stable predictive income from the assets that are purchased, and then to preserve capital and maintain regulatory solvency. So there's a lot of different components that must be achieved when building a strategic asset allocation. And it's something that is a core principle across all of the insurance companies that I've worked for in the asset management area. And I've grown up in insurance asset management. And I would say there's not a lot of variances to how it's done. It's more when you move tactically where there's changes. And that, of course, is evolving with new asset classes. And we'll get to the tactical side of it. But the strategic side is sort of creating that playbook. But then you have reality hit in markets and asset classes that behave in different scenarios. And you mentioned all the exogenous shocks that we must consider and then react to. So it's really dynamic, but the strategic asset allocation really sets that line in the sand of what we're thinking more in a long-term perspective for keeping the stability in the capital of the insurance company steady, strong, and able to be there for our policyholders, which is the utmost importance.
Yeah, it's super helpful. You said that you grew up in this business and I've grown old in it. So we've got that going on. You mentioned tactical asset allocation. And Harold, this is really for you. How do we define or think about tactical asset allocation in the context of an insurance portfolio and inside the confines of the strategic asset allocation or SAA that Kerry just outlined?
Yeah, so continuing with what Kerry said, implicit in your SAA is that it's the optimal mix based upon all the factors and considerations that she was mentioning. And so inherently, it's a passive strategy, or as I'll sometimes call it, a set it and forget it strategy, where you're not really expecting a lot of active management. But in contrast, tactical asset management really isn't a set it and forget it or a passive strategy. Instead, asset managers will be much more active in executing sector substitutions and deviating from that target mix at times in order to take advantage of market conditions when they've seen possibilities to add value, or even at times to preserve value by de-risking the portfolio if they think the market environment is deteriorating in some way. But, there is risk there. And the obvious criticism is that you could get it wrong. You could end up having poor market timing. And then you would end up hurting your returns and all the other considerations Kerry was talking about in the long run.
And it's one of those things that, I mean, in my experience, it is challenging, I think, at times when opportunities arise in markets and the flexibility from the insurance company to take advantage of those, right? I think it has to do to some extent with the investment committee giving the internal team enough flexibility to do that, because sometimes these opportunities don't last forever, right? The markets are relatively efficient over time. How do you deal with the potential lag on approval of a tactical, or does that flexibility already exist in the investment policy guidelines in advance that gives you enough flexibility?
Yeah, so I do think that flexibility is there. And a lot of it is, like you said, the integration with all the other teams and kind of going through the workflow. And so, what we'll typically do is analyze any tactical repositioning ideas or trades on a pre and a post execution basis, checking our subsector exposures across all asset sectors and making sure that we're adhering to internal policy and guideline constraints. And then that socialization starts to expand, where we start talking with our asset sector teams, subject matter experts, ALM working groups, and governance teams, and so on. And then at that point, we start to tee up and start coordinating the executions. And, I think another point that's worth noting is that these tactical ideas can vary quite a bit in terms of size and scope. Sometimes they're relatively innocuous and can be within a single asset sector. But then other times it can be much greater in magnitude, 500 million, 800 million, a billion or more, like when we're repositioning a PRT portfolio or another large business, and they can span across multiple asset sectors. And so when that happens, I'm focusing on the tactical side here. We may work with banks and look to coordinate program trade executions. And, I've always found that to be a helpful tactical tool to reduce your funding delays and reduce your transactions costs at the same time.
Yeah, it's super helpful. And that brings me to the governance, cadence, and tools section. If you could just, Kerry, start us off with, how does MetLife, and MetLife Investment Management has considerable analytics. How do you implement the tactical decisions and remain in compliance with all of your third-party asset management clients' individual guidelines and investment policy guidelines and limits?
Sure. Yeah. So we have every client's investment policy guidelines embedded into our compliance dashboard. So we know each day where we stand as far as limits on issuers, sectors, asset classes, if there's a duration band, where we are within that duration band, quality, wharf, all of that is on our compliance dashboards, our portfolio management dashboards by client. And then, of course, the team has a lot of knowledge and visibility on how each client thinks about risk and what their risk tolerance is. Often we do whole balance sheet analysis. So it's not only managing the assets, but it's also, we know the liabilities, the behavior, and optimizing portfolios within a regulatory regime. Is it cash flow matching in Bermuda? Is it RBC? Is it someplace in Europe? So all of that is part of how we manage client portfolios and client assets. So if we have a tactical opportunity, and I go back to Liberation Day in April, we wake up, this news hits, spreads blow out, 40 to 50 in IG, over 100 in high yield. What do? We know in the portfolios what we're able to do from an exposure standpoint. And then, of course, we have our teams on the desk that have names that they like in different sectors. So it's, all hands on deck, identifying opportunities, where can we position them, and then we're able to do that tactically. We don't have to stick to the strategic playbook. We can move into the realm of spreads have blown out. We have private allocations, but maybe we should think about the greater liquidity and maybe more opportunity in public markets because privates tend to lag on the repricing. So there's definitely a pivot. There's definitely a lot of discussion on the desk on what to do in an event like that. When spreads blow out, we want to take advantage of that. But we also, at the same time, we have recession probabilities going from 30 to 80 to we're already in a recession. So there's just a lot of work And it's exciting work to do on behalf of our clients. And then it's also, we're getting inquiry from clients about what do we do in this situation. And what's nice is a lot of them see it as an opportunity, although the tariff news was pretty hardcore.
And this kind of my next question really goes back to Harold and is sort of picking up on that point, Kerry. How do market dislocations, credit cycles, and rate environments influence your tactical decisions over time?
Yeah, so over the course of my career, I've seen a lot of different market events and dislocations. But just to use an example, COVID-19 is one that really stands out. Just as a reminder, I know nobody's forgotten the shutdowns and all the other uncertainties, but risk assets really got hammered in the beginning, falling about 32, 34% or so in that first month. And at that time, and times like it, I think portfolio managers struggle to be objective and not get driven by their emotions. And so, from my perspective, capitalizing on moments like that starts first with just taking a step back and trying to see things from an objective or even a contrarian perspective. I think you have to look at it as the price of admission of being an asset manager, right? We're here to guide clients through tumultuous times like that. And so, as that's happening, I try to remind myself of some famous contrarian quotes. One of them is the time to buy is when there's blood in the streets, right? And then another one is a pessimist complains about the noise when opportunity is knocking on the door. And, whatever they are, we could come up with a bunch of other ones. But I think those are really helpful reminders to give you a different perspective. Because if you can be measured and sift through all that noise, they can be opportunities to add exposures that you're comfortable with on the cheap. And, I thought the pandemic period was a really interesting time to do that across all asset sectors and ratings cohorts. And I'm remembering structured finance in particular, we'd often see really attractive entry points for pass-throughs and CMOs and ABS due to forced and panic selling. Whereas at different points in time, like the post GFC years and the QE era, we were all constantly dealing with historically low rates and spreads. And, being more offensively minded, so to speak, or aggressive, looking for opportunities was a lot less compelling. And so I think those are times to have those internal discussions where you can be a little more self-reflective and be a little more defensive or cautious. And so, I think encapsulating all of it, what it really requires is that continuous dialogue. It's a daily discipline. Any of these tactical ideas and so forth that you have to align with your client's risk appetite and the guidelines, of course, like Kerry was saying. But you have to go beyond that too and really engage the client and just talk with them every day. You have to move beyond the formal processes and the formal metrics and just make sure that you're integrating with each other and you're on the same page throughout the process.
Yeah, it's interesting that those are a couple of great quotes. We should probably implement a quote section on these podcasts. But if I've got this wrong, somebody can DM me on LinkedIn. But I think it was one of the Rothschilds that said, "Buy when there's blood in the street and sell too soon," which is I think is a fabulous quote. So getting back a little bit, I mean, and you, Kerry, you both kind of mentioned this. When you say risk or the perception of risk to an insurance company, that can vary quite a bit between insurance companies, even if they look very comparable on paper, right? And so when you think about what we're talking about here, what do you think are the most important risk and constraints you manage when you're executing tactical shifts within an insurance investment portfolio?
Yeah, it's understanding what the goals of the portfolio are. Some are just to support the liability. So you're doing ALM matching. So you're less flexible with a tactical shift because you don't want to sort of dislocate or mess up the ALM. So you have less flexibility. But then we have sleeves where we can just generate alpha. So those are much more just fluid dynamic where we're able to, whether it be a surplus sleeve or a sleeve of an asset class that we've been asked to position on behalf of a client. So there's more leeway to take advantage of spread widening or pivot from publics to private. So it really, as Harold mentioned, it's understanding the client's objectives, being connected with that client. So when there is a dislocation, you can go in there and optimize it and really get our best ideas of the platform. And our platform, as you know, is broad, it's deep, and very talented investment professionals. So it's really a great time to be able to showcase that and just being aware of which clients are open to that when the opportunity does arise.
Yeah, that's super helpful. Harold, are you good there, or did you want me to come to you as well?
Sure. I mean, I agree with everything Kerry said. I think the only thing I might add here is that if you become overly robotic or mechanical in your approach to your portfolio construction and your tactical ideas, there is a risk there. And I think it's one of those things where you really need to use experience and apply some art and science in order to get the best results possible. Because again, if you become overly robotic or mechanical, you risk your optimizations being overly simplified and gravitating much more towards absolute yield. And like Kerry was alluding to, there are a lot of other considerations that are often equally or even more important than just yield alone, depending upon your client and their circumstances. The impact to your cash flow matching, their risks of liquidity or views on the risk of liquidity, right? If you have a longer term investor versus a shorter term investor, right? If it's a property and casualty portfolio, they'll be focused much more on liquidity and shorter assets, right? But if you're managing on behalf of a client who has a much longer term liability, like a whole life liability with younger demographics, then their view on liquidity and their ability to take risk is going to be drastically different.
Yeah, it's really true. And I mean, your point about the robotic nature is a good one. And I'll slap my professor of finance hat on for a moment. But models are based on historical data, right? And they're based on historical correlations and historical volatilities and historical returns. And while the future may rhyme with the past, it may be very different. And your point about the art of this, there is art. And it is taking your experience over long periods of time in a variety of situations and doing your best to forecast what is going to happen in the future, right? I mean, I think, your point about COVID is really well taken. I mean, when that first happened, inflation was the last thing on anybody's mind, right? And yet the economy did better than we thought. We ended up with inflation, but you've got to be able to adapt to what the market is giving you, which I think, you articulated really well. And it leads me to my last point here, which is the road ahead for tactical investing. And looking forward, how do you see tactical and relative value investing evolving for insurers over the next several years? Do you think that more people will be looking at this? It obviously has benefits. Give us dust off your crystal ball and tell us about the future.
Yeah, sure. So insurers have been increasing their allocations to private assets and asset-based finance for several years now. I know that's a subject you've covered maybe one or two times, right? But, joking aside, assessing public and private assets is that compartmentalization has really eroded, right? So insurers are looking at both spaces on a holistic basis, net of capital, considering illiquidity and so on. But to your point about the crystal ball, where I think insurance asset management is probably going is the insurance asset managers are going to be looking more and more, I think, towards customized solutions like securitizations for better capital treatment, repacks, warehousing, rated feeder structures, and so on. And when you think about it, these are all just ways to restructure different collateral pools and different asset classes to get better capital treatment for income enhancement, to accelerate your funding, and even at times to improve your ALM. And I also think it's a way for smaller companies in particular to get access to sectors where they may not have scale or capabilities, or they have barriers to entry of some kind. And so I think maybe the final thought on this in terms of the future is that insurance asset managers are going to be moving more and more towards AI-driven solutions and just automation in general, so that they can keep up and continue to be agile and have more flexibility to changing market dynamics and a changing regulatory landscape.
Yeah, that's super helpful. I really appreciate that. It's really a thorough and thoughtful answer. We've come to the part of the program where we ask you a question about that really reflects the culture at MetLife Investment Management. And I'd go to you on this, Kerry, is what characteristics are important to you? I mean, you've had a very successful career with a few different firms, all of them top tier. And I was talking with a young person yesterday who's a rising junior at UCLA, and talking about his desire for an internship. And it's really that student. I gave him some podcasts to listen to. I said, just go to the end and listen to this question, which is, what characteristics are important when you're adding to members of your team beyond the hard skills and quant skills that I think are kind of table stakes for this business?
Yeah, great question, Stuart. So I would say, and our president at MIM says asset management is a team sport. So, and we certainly take a team-based approach to asset management. So team fit is number one and essential to landing a job at MIM. You have to be a team fit. You have to be a strong collaborator. You have to be curious about markets and learning, and be willing to roll up your sleeves and do pretty much anything that is required to get to the end result. We have a solutions and advisory platform, so with a client first focus. So going above and beyond for the client and the team. So that's really one of the key attributes, and it is table stakes to have all that analytical acumen, be able to build spreadsheets, know how to use AI. As you know, AI is penetrating our business, all businesses. So being able to use it, be productive, and at some point down the road, be able to have it impact our ROIs. Not yet, but so yeah, definitely be a team player and be very curious about insurance. I know that insurance has this view of being sleepy, but it's not sleepy at all. Maybe one day long ago it was, but it's very dynamic, exciting, and there's a lot going on in insurance asset management.
Kerry, I couldn't agree with you more. I am the flag bearer of the Insurance Asset Management is Cool parade. So trust me, I'm with you. I think this is a great industry. I love it. I love the insurance side of it as well. So, all right, final question. And there's two of you, so you each get one pick. Dinner's on us. Who would you most like to have dinner with, alive or dead? Harold, we started with Kerry last time. I'll come to you, and then we're going to go to Kerry.
Oh, thanks. This is a problem because I enjoy talking and I definitely like to eat. So I would need an unlimited budget and calendar, I think, to get everybody in that I really would like to. But since I'm only limited to one, I'm going to go with Jesus. I think.
There you go.
Is there a bigger historical figure? If they still know who you are and they're talking about you 2,000 years later, I think that's the first person that I want to have a meal with and talk their ear off.
You know, it's funny you say that. I think Buffett's the leader in the clubhouse, but Jesus is second. And we've had some other folks say that, and great answer. Thrilled with that. Kerry, how about you? It'll be Harold, Jesus, and you. And who else? Please,
well, Stuart,
pick me.
I'll disappoint you. I'm going to say the same person I said during our last podcast a year or 2 years ago, and it's Warren Buffett. I've had a crush on Warren since I was probably in middle school or high school. So just I'm so intrigued by his track record, how he approaches the market, people, his family, his lifestyle. Would really love to enjoy a lunch with Warren.
You know, it's funny. I think I may have mentioned this, but when I worked at one of the firms in my past, which was owned by Buffett, owned by Berkshire, and I had the opportunity to be in two different sessions where they invited senior members of the team. There were about 500 people in the room, and he was there. And he is such an interesting person. He is exactly the same person that you see on CNBC or Bloomberg or wherever else, and he speaks publicly. He is it seems like common sense when he says it, but so few have been able to do it. So, really appreciate both of you being on. It's terrific to have subject matter experts who really know their stuff in the insurance asset management business, like in the weeds. And so very happy to have you both on.
Great. Thanks for having us, Stuart. It's been a pleasure.
Appreciate it. Thank you.
We've been joined today by Kerry O'Brien, head of multi-asset solutions and Harold Myers, CFA, insurance strategist at MetLife Investment Management. If you have ideas for podcasts, please shoot me a note at stewart@insuranceaum.com. If you'd like to watch us, some folks are video these days. We have a YouTube channel at Insurance AUM Community. My name is Stuart Foley. I'm your host on the insuranceaum.com podcast.